We got more unfortunate news for Tesla stock investors this morning as sales figures out of Europe showed continued huge declines in Tesla car sales, while the overall EV market increased in Europe, signaling Tesla's continuing losses in market share. Now, I know a lot of Tesla stock investors will say that EV sales don't matter for the company. What matters is artificial intelligence and driverless car technology. And to some degree, that is true. Most of the company's valuation is based on driverless car technology, robotics, and things that are going to happen for the company 5, 10, 20 years down the line. But I'm going to talk about why slowing EV sales will hinder the company's ability to achieve those goals. And I'll share with you the precise details on why I think that's going to be the case.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so this morning we got news that the European Automobile Manufacturers Association said that Tesla EV registrations, which is a proxy for sales in Europe, fell by 28% to 13,863 in May compared to last year. Meanwhile, overall EV registrations in the region, which includes the United Kingdom, rose by 25%. So overall EV sales are rising, which is good news for Tesla because it benefits its energy infrastructure. But Tesla car sales are falling. They're down 28%. So those are huge losses in market share for Tesla. And some of it has to do with the CEO's political views and political actions. But I think a lot of it also has to do with the companies losing a competitive advantage with newer models coming into the market, giving consumers a reason to buy other models, right? Consumers don't just buy cars based on the performance metrics of the vehicles. Consumers buy cars based on the way they look, the design, the freshness of the model, the colors, and a variety of things that lead to a purchase decision. And so, with newer models coming into the market and more availability, consumers are choosing other options. Whereas in 2018, let's say, or 2019, even, consumers didn't have very much choice. So if they wanted an electric vehicle, they chose Tesla. So now Tesla faces competition and it's not performing well amid the competition. So May's total marks the fifth straight month of declining Tesla sales in the European region. So this decline in sales was not like a one-off thing. Tesla sales in Europe has been falling all year long. But the good news is that the drops are improving. In April, sales fell 49% year over year. So the declines are improving. And that's what you'd like to see when you're investing in a company that's going backwards. You'd like to see them moving slower. You'd like to see the declines slowing down, which is what happened for Tesla in today's report. So Tesla stock was down roughly 4% on the back of this news. Anytime Tesla stock falls, it's a little bit surprising to me, especially when Tesla stock falls based on fundamental factors, because I view Tesla and Tesla stock as a company that doesn't really trade on fundamentals. If you look at the actual results of the company, there's no reason why the stock should be trading at the valuations it's trading at. Tesla shares are trading at a forward price to earnings of 153. This is typically a valuation I would see for a company with very strong performance, revenue growth accelerating, profit margins expanding, cash flow from operations increasing, a strong competitive advantage in an attractive industry. None of those things are true for Tesla, but still the valuation is super expensive. And I point to this fact as one of the reasons why I call Tesla the best marketing company in the world, because they've been able to hold such a premium valuation while not delivering very much in the form of tangible results to investors. So I mentioned why slowing EV sales will matter for Tesla, even though I agree that most of the company's valuation is due to the prospects in driverless car technology. And here's the reason why. So you can see here recent performance for Tesla, and you can see the declines right already in the first quarter of 2025, which they reported on. Total automotive revenues were down by 20%, gross profit was down by 15%, and operating income was down by 66% to just 399 million. So the reason why this matters is if you look down lower here. So here you have the company's cash flow from operations, capital expenditures. Okay. Capital expenditures are investments the company makes in projects for the long term. These are perhaps those data centers that house the artificial intelligence capabilities that's developing the driverless car technology. So the more money that Tesla makes from car sales, the more it can invest in that technology and the sooner it can develop the technology because it can buy more of the GPUs from Nvidia. It can add more to its data centers. It can increase the number of data centers. It can increase the amount of spending in categories that help facilitate that. It can start building up the manufacturing facility and updating the manufacturing facility to ready for the robo-taxi launch. All of those things cost money, right? And so the more money it makes from electric vehicle sales, the more it can invest in that category. And the opposite is also true. If Tesla's not generating cash from EV sales, then where is the money going to come from to invest in that technology? Tesla does not have an infinite amount of cash, although they do have a very strong balance sheet. They have $37 billion in cash that they can invest for the foreseeable future to develop that technology. But this money runs out quickly for electric vehicle companies. I don't need to remind EV investors, if you're aware of Rivian, remember at one point Rivian had close to $20 billion in cash and how quickly they burned through that $20 billion and needed to sell key technology to VW just to survive so that they can develop more because that $20 billion evaporated so quickly for Rivian with very slow growth in EV sales. Well, the same thing could happen to Tesla if EV sales continue to slow as they're slowing, because their cash flow from operations will decline and that will limit the amount they can invest in developing that new technology, right? Already in the most recent quarter, only 399 million in operating income. I wouldn't be surprised when they report Q2 results if their operating income is close to zero or even negative, because in the first quarter, automotive sales were down 20%. Automotive sales are already tracking to be down much more than 20% for the second quarter. So if they generated 400 million in operating income in Q1 and sales are lower than they were in Q1, then perhaps its operating income might be lower. Now, Q1 is usually a lower sales quarter for Tesla. Q2 is typically a higher sales quarter. So even with the percentage decline year over year, quarter over quarter, the declines may not be as much. And so operating income might still be positive, but there's a chance if sales continue declining the way they're declining, and we don't have more precise data out of other segments. China is notoriously been difficult for EV companies in 2025. There's a fierce price war going on there. So there could be big losses in operating margin for Tesla in China. And we've had some anecdotal data from California, which is the biggest EV market in the United States, as Tesla's market share is falling in that region as well. So for now, Tesla's balance sheet is fine, $37 billion, and it still generated 2.1 billion in cash flow from operations. But already you saw that big decline in capital expenditures, which are the investments in the new technology, right? They invested 1.5 billion in capex in Q1 2025. That's the lowest it's been going all the way back to Q1 2024, right? 2.8 billion, 2.3 billion, 3.5 billion, 2.8 billion, and then all of a sudden just 1.5 billion. And then in Q2, what's that number going to be? And then moving forward, as they experience those declines in sales, they will likely decrease that capital expenditure to moderate based on the declines in cash flow from operations. And also, this puts into doubt another one of the CEO's bold predictions. Remember at the beginning of the year, the CEO of Tesla said that their automotive sales would rise by 20 to 30% in 2025. He said those sales would rise 20 to 30%. In fact, it's going in the opposite direction, where sales are declining by 20 to 30%. And of course, if you've been a Tesla stock investor, you're probably aware of all of the overpromises and underdeliveries from Tesla CEO, but this is just yet another data point. And this is just to temper your expectations as the CEO touts the company's ability to generate $10 trillion in valuation and trillions of dollars in sales from driverless car technology and a few trillion more from robotics technology. Just remember to keep in mind all of those overpromises and underdelivers in the past so that you can temper your expectations and you don't get ahead of yourself in paying these super premium valuations for a business that's in decline, that's not generating growth, okay, with too much hope for this new technology that may or may not come to fruition at the levels that the CEO and the company are claiming. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.